Hey guys, Mike Thornton here. It is New Year's Day 2022, hence the casual look. But I wanted to make a quick video talking about the hottest topic in the economy this year, and that's inflation. So Milton Friedman, the famous economist, once said that inflation is the only form of taxation that can be levied without any legislation. So what does he mean by that? Well, here's a couple more ways of defining inflation. Inflation is more money chasing the same or less goods, or it's increasing the money supply in comparison to the number of goods, driving up market prices. So now that we know what inflation is, why are we hearing so much about it these days? Well, for months, households in America and many countries worldwide have watched in horror as the cost of goods and services have skyrocketed to historic levels. The Consumer Price Index, which measures a wide-ranging basket of goods, surged to 6.8% on a year-over-year basis in November, the fastest rate since June 1982. And quite frankly, many believe that the number is higher than that. For example, the input for housing costs into that metric was well understated compared to other housing data published by the National Association of Realtors, Altos Research, and many other organizations. Now, whether it's 6.8%, 10%, or higher is debatable. However, what isn't debatable is the impact it's having on most American families. A December study by Gallup reported that 45% of American households say that inflation is their number one worry in financial hardship. Now, unsurprisingly, lower income households are the most affected. Of those earning less than $40,000 a year, 71% said recent price increases have caused hardship. Now, even Wall Street investors are sounding the alarm. According to a CNBC Delivering Alpha study, inflation is the number one roadblock to markets in 2022, and stocks will only see a modest return because of it. To explain the inflation crisis, we must first understand that there are actually deflationary forces on consumer prices in the economy too. Think of these as forces that are fighting against inflation, or they're headwinds to inflation. Now, here are some deflationary forces courtesy of Lynn Alden at lynnalden.com. Number one, high private debt levels are deflationary since it makes consumers and businesses financially restrained and risk averse. Number two, slowing population growth and aging demographics are deflationary since resource demand slows. Number three, technology is deflationary. Obviously, technology is making things cheaper and better. Number four, wealth concentration. If you have wealth in fewer hands, there's less circulation into the economy. Five, commodity oversupply is deflationary since it cheapens the building blocks for everything we use in life. And six, outsourcing is deflationary since it lowers our labor costs. Now, in a low debt environment, deflation can actually be a positive thing. It means your money's purchasing power grows over time as higher productivity from technology enhancements lowers the cost of goods and services. However, in a high debt system, you can thank our government and central planners for this, deflation breaks things and results in widespread defaults because the cost of servicing debt goes up relative to cash flows. And so it just so happens that the U.S. finds herself as the largest debtor nation in the world. That may shock some because we were once the largest creditor nation in the world as early as the 1980s. So, given the high debt system we're in, our monetary policymakers must deliberately push back on the deflationary forces with inflationary policy to alleviate the cost of servicing our national debt. So let's ask the question again, what is driving inflation? At the very least, it's our own fiscal policy. But in fairness, that's not the entire picture. Supply chains are a wreck, and that does impact production of goods and services, which lowers supply and causes inflation. But was that self-imposed? Many argue it is. Now, inflationary policy, in addition to supply chain disruptions, would be enough for raging inflation, but we didn't stop there. The government's been pumping money into the economy like drunken sailors at the very same time. In the US alone, money supply rose 5.7 trillion or 38% in just more than a year, at a time when the economy wasn't making any money. Now again, there's probably good reasons for that. Many argue we needed that to keep going, and I'm not going to take a position either way on that. But it did increase our money supply. Now, there are two main ways you can infuse money into the economy. Either banks can lend it, think lucrative housing programs, down payment assistance programs, or the federal government can go around them and run big fiscal deficits. Now, think stimulus checks, child tax credit checks, etc. Now, loan growth was non-existent during the pandemic, meaning banks were not lending more. However, the broad money supply spiked dramatically because of the stimulus programs. So, there you have it. The long-winded answer to why we're experiencing inflation. We've had bad fiscal policy over the decades, we have had a shot of supply chain issues, and we had a dash of stimulus on top of that. Now, the problem is inflation is really hard to get under control once it gets rolling downhill. Economist Peter Schiff says inflation is going to get much worse this decade. He suggests the Fed can't tame inflation without jacking up interest rates, and they can't do that like 1980 because the national debt is where it is. The government will be crippled by trillions in additional interest on the debt. In 1980, we had trade surpluses, but now that we have trade deficits, it's a completely different position we're in, a much weaker position. As mentioned before, we were the world's largest creditor nation, now we're the largest debtor nation. The cure for inflation would crush the economy, and that's why we can't do it. Inflation is here to stay. Now, side note, you're going to start hearing more about price controls in relation to curbing inflation. You've already heard some of the rumblings, and some outlets are calling for it. This, in my opinion, is dangerous as the government deepens their control and overreach. Okay, so snapping back. Now that inflation is likely here to stay, what can you and I do to protect our purchasing power? Now, the answer may surprise you. It's fixed rate debt. How can that be? How can taking on debt be the answer to inflation? Robert Kiyosaki has been quoted to say that fixed rate debt is the real asset in real estate. I would bet that most Americans think that a 30-year fixed rate mortgage is normal. However, that hardly exists outside of the United States. This type of debt is available only because it's subsidized by the taxpayers in our government. The reason it's subsidized is that the banks would almost be guaranteed to lose money without it being subsidized. Therefore, if the banks are guaranteed to lose money, you and I are guaranteed to make money. Here are 3 reasons fixed rate debt protects against inflation. Number 1, fixed debt increases your purchasing power. Even though inflation is going up every year, your debt payments stay the same. The discrepancy or the difference between your debt payments and your income is money in your pocket. In other words, purchasing power. Number 2, as a homeowner, you enjoy the appreciation on the entire value of the asset, not just the portion you own. If the down payment was $50,000 in a $500,000 purchase, you, the borrower, pocket the appreciation on the entire $500,000, not just the amount of equity being $50,000 that you put into the deal. Now, number 3, you're repaying the debt with cheaper dollars that don't buy as many goods and services. Now, this might be the best part. Your monthly payment will always be the same over the course of the 15 or 30-year term, depending on the loan term. However, the dollars you're paying in down the road are debased or less valuable. The house is effectively the most expensive on day one and becomes less expensive over time in relation to other goods and services. Other than locking in super cheap money with fixed rates, be focused on the following things as well. Number 1, adjust your monthly budget to assume 15% higher costs for goods, energies, and everything basically that you buy. Number 2, think about starting a side hustle to add some extra income cushion. 3, shift behaviors. Go from eating out to eating in, chill on the dozens of streaming services you're signed up for, etc. Number 4, think about investing in assets that tend to inflate with inflation. Now think dividend paying stocks and real estate. Number 5, educate yourself. Be informed, but don't live in fear. Have fun and enjoy life. Hopefully you learned something today. Hopefully you have a better understanding of what's going to happen with inflation 2022. If so, give us a like, subscribe, and we'll see you next time.